All right. Good morning, everybody. We're going to get jobs data today. Not the big numbers, just some JOLTS, but any job number at this point is numbers that we want to pay particular attention to. If you're new to all of this, the JOLTS number is what we call the take this job and shove it numbers, right? If you remember back in the day, say 07, 08, jobs were really scarce, and if you had one, you fought for it. You hung on to it with dear life because you didn't know if you could find another one. It is the perception of how easy you think it will be to leave the current job that you have and find another one somewhere else, the JOLTS number. So this isn't the biggie, but right now, especially after Powell's pivot in Jackson Hole, we want to see if there really is a Fed put, and we're likely to get that answer today with JOLTS. So let's be prepared for that at 8:30. I don't think it is going to be enough to generate a liquidity gap, but you never know, right? I mean, really, at the end of the day, we just don't know. So other than that, it's going to be likely kind of sleepy. Wednesdays is where we typically get the crude oil inventories, the strategic petroleum reserves and all of that. But because it's a short week, it's very likely that we're going to get that and gas tomorrow at 10:30 rather than getting it today. That's the way it typically goes, right, on a short week. There's still a lot going on in the bond space. It seems that bond traders woke up around the world. They're not yet really throwing a fit, but they are getting the attention of market participants. And Japan's the one that's feeling it the most. Keep your eye on what's going on in the Japan market space, especially in the FX markets. So we're going to get some Fed speakers today and the beige book this afternoon. Not really too concerned on that one. I don't think Kashkari's got anything. The Women's Economic Roundtable. Yeah, maybe if they're doing a Q&A afterwards, there's an opportunity for some volatility because, of course, they can be taken out of context. They could inadvertently say something they didn't mean to say, or they can just, FUBAR 101, chew on their foot and mouth. Other than that, very likely the Kashkari speech isn't going to be much of anything either. So it's JOLTS today, biggest thing on the book. The Russell's down the most this morning, but not even 0.25%. And looking at things going the other direction, we've got the NASDAQ up more than 0.5%. So a really big shift. If you think about the way most of August went, every morning it was like small cap leadership over and over and over again. Yesterday, listening to a lot of Bloomberg talk about IPOs and how they've got a lot of IPOs coming out this month, which puts them in a kind of a bit of a bind since this is seasonally a weak part of the year. But depending on the space that the IPO is coming out in, they expect you know things to work out pretty good. So keep your eye if you like to speculate, keep your eye on the IPO space over the next week or so. Could see quite a few in AI. What's the matter with you, grumpy cat? AI data centers. Yeah, just walk away. And there was one other space that's been really popular. I think it was uranium or energy. The SMRs, but I'd have to refer back to my notes. Just IPOs in general, if they're not in the hot space, and or if they're not already showing uh, increasing revenues, maybe approach with a bit of caution. Cat's got attitude this morning. All right, so the call and the put wall really didn't change all that much, and we can see nearly all of them without having to adjust the charts. I guess it's just, there it is. I thought I saw them earlier without having to adjust. So everything's within view. We are just compressed a lot, right? We got all of the moving averages compressed here, all of the options levels compressed here. Everything is within this zone. And the one line of defense we have is the 10-week moving average, that cyan line down here. It's been trailing behind us nice and easy. Thing is, it's getting closer and closer and closer. Right? And that's typically the case when we are digesting. Now, yesterday, I pointed out on the daily chart how this halfback lines up where they have been defending, right? That every time we come down into here, there's been buyers willing to pick it up. Yesterday was no exception, right? We came right down into that level. They defended it, and up we went. It was a really nice play, too. I hope you guys caught some of that, just anticipating the move, right? Because it was a nice pattern if you like trading the 5-minute. Get what you can get, right? Not bad, not the best pattern for a reversal, but it wasn't bad. So you would take what we can get. But what I liked about yesterday's reversal is it happened where it was supposed to happen, right? And it didn't have the gusto that we're supposed to see if it was a good double bottom bear trap, right? We should have seen the ferocity of them exiting their position, and we really didn't get that. So that was the one missing piece if we were gonna critique that double bottom of yesterday. Still, it happened in the zone where we expected it to happen. So they are still defending that level. And when we put this higher low into perspective with this higher high, then the trend is still intact even on the daily. We already knew it was intact on the weekly because we're still above the 10-week, but now we've got confirmation that it's still intact on the daily as well. Now we want to focus this same sort of approach, the same measure concept, to a couple of different places. And it's not about which is the right way or which is the wrong way. It's just about getting some answers. So I went to the very top down to the very bottom of this current move, and that gives us a halfback 64.47. So let's just get rid of some of these other lines. They're a bit noisy. So we have that. We also need yesterday's half. 64.32 cog line. Imagine that. You know, I get asked about these cog lines all the time, and they're complicated. They are derived from historical data and options and volume, and it takes months to validate them. I gave up doing that work years ago because it's just so much work, right? Each line takes months of crawling through 1-minute data, looking at the options that were traded at certain prices during the day. And after a while, you just get tired of doing that much effort, right? There's 3 numbers that repeat over and over and over again. And I've been doing these since the S&P was at the 3,000 level. We're at the 6,000 level now, right? And I learned about it when the S&P was in the 2,000 level, when it was 2,800, 2,850. Imagine the S&P at 2,850, because that's, you know, where I learned way back when we were way back there. So the 3 numbers that just keep repeating over and over and over again without having to validate them: 11, 32, 92. Right? So on the S&P, the ES, or the SPX, keep your eye on those 3 numbers: 64.32, 64.11, 64.92. And here we are again with a halfback, 64.32. Yesterday's midpoint. We want to stay above yesterday's midpoint. Now we can check it, we can fade down and break below it, but we want to get back above that level by the end of the day today, right? It's really a line in the sand that we want to hold above on the week. So yes, we can get down below it. We don't want to close below it, and certainly don't want to continue to drive farther away from it, lower and lower. 64.11 cog line is lower, than that. It's really a lot closer to the meat of the move of yesterday's price action is down in this zone. But the next line of defense under 32 would be 64.11 cog line. That would also put us back below the 20 period moving average. And as you can see, maybe not, because chart's a little messy here, but we got the 10 period and the 4 period moving average over our head right now. So if we try to continue this run to the upside, we're going to get hung up at the 10 and the 4. The good news, I suppose, is that we are back above the 20. We're back above the 3-week. And the 3 is still above the 10. So if we can get back above that 10, maybe we can stop the 3 from crossing below it. We'll take what we can get. Yeah, back in the day, right? The ES was at, when I was trading, when I was first getting into trading, the ES was at 3,000. I wasn't trading it at 3,000. I was still learning to trade at 28, 29, and then 3,000. It wasn't that long ago, right? Back here. I wasn't trading futures then because we didn't have the micro. We only had the mini. But I was trading options and SPY back then. Then we had the October surprise and the Christmas save-a-ho when Powell came in and saved markets and ripped it back up on the other side of Christmas. And then we had COVID and on and on and on, right? It's just a walk through economic events for every one of those little patterns all the way back up. So we've had those cog lines forever, right? Is the point. And I've done videos on it. I've talked about it before. It is complex. It's complicated. If it takes months to even perform, you can imagine that, it would take a considerable amount of time to try to explain to someone. And that's if they are an options nerd that understands what the heck I'm saying in the first place. So I don't teach how to do it. I don't even do it myself anymore. It's just too much work. There are other cog lines though, if we was to go in and validate price action. But it's not worth the effort, especially if we move through a zone and then we've never been back there again, right? Or we haven't been back in so long that, because I still got all the zones from 3,000, 4,000, 5,000. I've still got those levels marked out. 28, all of 28, 29, 3,000, 31, 32, 33. I've got all those charts and lines saved. So 88's a common number, 62, 42. They just weren't as common as 11, 32, 92. Today's volume, 87,000. It's looking pretty good. Yeah, it's 2 days in a row now where we've got elevated participation. And this capital rotation's acting a little off, right? And it's not yet getting on everybody's radar because, well, we're not crashing and burning, but VIX is picking up. We're seeing a little bit of a shift on the long end of the curve when we start looking at bonds and treasury and yields. And I definitely don't like the things that I'm seeing out of Japan. So there is some serious risk on the table, but we held above that line yesterday, right? They did defend it. They came in with gusto and protected that low. And so far today, we're above both of those halfback levels that I drew. The bigger level that marks it from the top to the bottom of the pullback, and just yesterday's level. We're above both of those, and we kind of want to keep them. If you put those two levels together, they make for a really nice zone, right? We just kind of mark those two halfbacks with a box, and then we can get rid of all the noise here. That's a little bit better. So this is the zone. We need to get out of this box and stay out of it. But you can see the 3 and the 10 right above us, and that's what we're fighting against. I do like that we're already back above the 20, because the longer we spend below the 20, the more likely it is we're going to bring the 10 and the 3 below the 20. And that's things are going to get a lot nastier after that. So as long as we don't spend a lot of time under the 20, they won't cross below it. And, Bob's your uncle. I ain't old. You're old. Oh, that's messed up. Looking at the ADR lines, of course, we're up 0.5%, so we're closer to the upper ADR than we are the lower ADR, but we were already closer to the lower ADR today than we are the upper. So base case argument is that we don't get to either line today and we just hang out between the level. Why? Well, because that's what we do most of the time, right? That's average daily range. It's all in the words of the name of the thing. What have we done on average over the last 21 days, which is one market month? In the last month, what's the daily move in the S&P? Up and down. About that much. It's about 61 points or around 1%. Now, if we get frisky and go in one direction, 1%, we would hit the upper or the lower yellow lines. It'd be those lines here and here. And that would be, we get all bulled up, we get there, we get all bared up, we get down here. But we're not expecting to do that unless we get, some odd numbers that we're not expecting in the JOLTS. Otherwise, we're expecting just a kind of nothing day, right? And look at the differential here in the JOLTS. It's like, this is nothing. If this is what we actually get, the market's just going to shrug this off and not care at all. Now, the factory orders, on the other hand, which is going to be coming in at the same time, that's a little bit of a spread differential there between 1.4 and 4.8, both negative. That could cause a lot more shenanigans than the JOLTS number, honestly. JOLTS, most of the time, it's not that big of a deal. The only reason it's even getting elevated to the status that it is right now is because of what Powell did in Jackson Hole. Otherwise, yeah, it is jobs data, but this isn't the jobs number that we're looking for, right? These are not the droids that you're looking for. Nerd. It is worth noting that you can reach both ADRs inside of yesterday's price action. We don't need an inside day breakout to get to either red line. But to get to the yellow line on the upside, we would need an inside day breakout, which puts a little bit of a handicap on reaching the 65.11 cog line. But we don't have any reason to suspect that today's going to be violent or that we make any big moves unless we get some news. And so staying within the red lines is the base case scenario for the day. What is that thing anyways? Is that like a, what do you call it? Telegraph machine? Oh, the old ticker tape. Yeah, yeah. Boy, you're talking about taking tape reading to a whole new level, huh? So on the weekly floor pivot, our distance below never got to an extreme. So the, if we're looking for any sort of mean reversion back towards the middle, uh, this isn't mean reversion. We didn't get too far away from that. Today's floor pivot is significantly lower than yesterday's. That's bearish. Price opened above it. That's bullish. Those two kind of cancel each other out. The width of the channel today, while it's not as wide as what we had, say, last week on Friday, that's a wider channel, it's still wide. And wide channels imply that if we attempt a breakout, that it doesn't stick. Now, I've had people say, I don't understand what you're talking about on the breakout. Well, this is yesterday's price from high to low, yeah, Globex and RTH, everything. This floor pivot says if we break out of this box, it likely doesn't hold and we come back in again. That's the breakout that we're talking about. But to even get that discussion, we'd have to get to the edge of the box and attempt to break out. Otherwise, just getting to the edge would be a feat at this point. Because of yesterday's expansion, it is worth considering where the SNR levels are right now. They adjust on a day-to-day basis based on what happened the previous day. So you can see that yesterday's range was kind of small because it was after a holiday, or even look at Friday's. That's a really narrow range. And yet look at today's range between the SNR levels. It's much bigger. It's almost twice the size of Friday's or yesterday's. So the reason I bring that up is there are strategies that talk about going from R1 to S1 or S1 to R1. Look at how far away those are. Just getting to those levels would be an accomplishment, let alone actually trying to get to both sides today. Now, is it possible? Oh, yeah. I mean, price can do whatever it wants. It's shown us that over the years. But is it likely? No. It's not even likely that we get to one side today, let alone get to both sides. You got to ask, what's fueling the move? 1.21 gigawatts, right? They said, get it with a bolt of lightning. Maybe we get some energy and move this thing. But so far, we just don't have that expectation. If we continue this drive to the upside, we've got 64.72 overhead. It's the point of control of last week's range. There'll be some structure there. And if you look, it's actually 3 weeks of structure up there. They're not perfectly in line because, well, I mean, this is, the real world, not some hypothetical textbook. So they're not perfectly centered, but they do develop a zone or a range up here. It's going to make it really difficult to get through. Just like looking at that daily chart and the defense that they had put in back here, right? They put in a lot of defense back there. So we had the expectation that it was going to be an area that would get defended again if we dropped down into that zone. And sure enough, they were there and they defended it and ran it back up again. Well, it's very likely that they're going to defend this zone up here as well. So we've got buffers on both sides. And until that breaks, I don't see us going anywhere. This is week 4 now, right? Actually, it's even more than that if we count all the way back here. But I was just counting this area. And we're on week 4. If you want to back that up even, all the way back here, then since mid-July, we ain't done much of nothing. But to me, the first box is more prescient. We are at 64.50 and we are running 50s. So if this does give up, then 63.50 is on the table and then 62.50. And I know, I get it. The last time I said 62.50, I had 3 people reach out talking some mad trash. And yet it wasn't that long ago when we went down and we got 62.50. And where were we at the time? 64.50. So I get it, right? I'm not saying we're going to 62.50. I didn't even say it back here. I said that if we break one level, we're going to the next level. And if we break that, we're going to the next level because that's just the way it goes, right? Don't argue with me, argue with price action. So you have the numbers, right? If that breaks, we're going to go to the next level. And if that breaks, we're going to go to the next level. The key is trying to identify where the next level is. But what I see a lot of traders trying to do is figure out if it's going to break in the first place. I don't know, and you don't know, and you don't have a crystal ball. I don't either. We don't know if it's going to break. We just make a plan for if it does break, what are you going to do about it? We try to make some money with it. 10-day, 30-minute volume profile in TPO. Not expecting any change here. We're lined up on the TPO and the volume profile. They match nicely. We have nothing here. There's no pattern, no shape, not even a really good distribution. And we're not going to move that point of control anytime soon. The last few candles that made the point of control up here, they're not going to move it. So we're going to need days after that to get into these candles. And, maybe by then, if we've revisited 63.92 cog line down here, that might be the new point of control. But we're talking at least a week. At least a week. So, if we're looking to get this resistance moved out of our way, we've got some time before that happens. We still have that VPOC overhead at 65.18. At this point, it seems that it's going to be there for a while. We got a new one yesterday from 64.11 hog line. I don't get these things to the tick because I just don't care. Get them close enough to the closest point is good enough for me. It's a VPOC from yesterday. It's a point of control. The textbooks would tell you to carry that forward every day. The value area high, value area low, and the point of control. I don't do that. I've got so many pivots. I don't need these. But I do pay particular attention to the point of control of the previous day if we have not yet hit it after it's been made. So for an example, back here on Thursday, we traded through that whole day. Once the day was over, mark that point of control. We've never been back to that spot. So it's a virgin point of control, VPOC. Hey, I don't name this stuff, right? So don't get upset about the naming convention. Traders are just sick individuals, right? That's why they got dead cat bounces and all kinds of things. I'm not bouncing kitty cats. Until we reach that level again, it is a VPOC. Now, once we've reached it, at the end of the day, I'll take it off. I don't take it off as soon as we hit it. It stays there until the next trading day, and then I take it off. So we built a new one yesterday. 6411 is down there. Until we hit that level, I'm going to keep it there. There is a little caveat to all of this. We're using an expiring contract, right? The ES. If you're doing this on Apple or Microsoft, some equities somewhere, you have no reason to remove it until it was hit. For us, once we swap over to the new contract, say within a few weeks, there's no reason to keep this, right? It wouldn't have any bearing to it. Because when we look back at a previous day's point of control, I've seen people call it support, resistance, all kinds of things, and that's just putting your bias into it. But what if we didn't put any bias into it? What if we just give it fact and just state what it is? It's where the greatest amount of trading took place on that day. That's it. Now, there's no bias there. I'm not making any assumptions that it's going to support price or resist price or do anything with price. It's where the greatest amount of trading took place on that day. If we revisit that level, those traders may want to rethink their position. Other traders who didn't get a chance to get in that day at that price are going to have a chance to do it. So we can call it trader's remorse, whatever you want to call it. If we go back there on a whole new contract series, we have no expectation that there's any sort of trader's remorse. The traders who got in on the previous contract had to roll that contract or close it. Therefore, it really doesn't have any value anymore, right? And so I don't carry them forward once the contract has changed, after a few weeks after the contract has changed. But if, like I said, if you're doing equities, you wouldn't have any reason to remove the level until it gets hit. So, you have to make a leap there between the contracts that you change or the product that you trade to just make an informed decision that matches what you're trying to accomplish. We did reach the edge of the weekly expected move yesterday, which is nice that we managed to get back up inside and stay there. Because we did that early in the week, that's usually a tradable opportunity, right? I tend to go into short puts when we do this. The problem is it's a short week, and short weeks are notorious for breaking statistical measures. So what I'm saying here is this range is a 1 standard deviation range. We should close inside this range 70% of the time because that's a 1 standard deviation. And by close, I mean end the week on Friday in that range 70% of the time. And if you know that number, that's a pretty good number, right? You can bump the odds up even greater and change a 70% trade into like a 90% trade. But if you go back and look at holiday weeks where we've had a short week, 3-day week and a 4-day week, the number drops drastically. It's not a 70% number. It's not even a 50% number. So as much as I love these weekly expected move ranges, and I am a firm believer in standard deviation, I don't trust holiday weeks. This typically would have been an opportunity to sell some puts, which is different than buying calls. Right? If we buy calls, it's because we think we're actually going to make it back to the other side by the end of the week. I mean, that's doable depending on what caused the drop and why we think it's going to run back up on the other side. But on a short week and in this situation where, we just came back to this level and it got defended, I'd rather sell puts here. Puts say, hey, I don't think you're going to go lower than that low. Well, that's completely different than saying, hey, I think you're going to hit that high. Selling puts is the better trade. I wouldn't do either one of those on a short week, though. Not unless you can keep the risk down, right? Because, I mean, if you can keep the risk down, who cares? Do the trade. That's what it's all about, anyways. We are below the 10-day again. It's not the first time we've spent multiple days below the 10 this year, and it's fine. It's all a part of that pullback structure. But as we've done a lot this year, the expectation is that we're just going to come right back up again. We still don't have any reason to believe that we're going to change this regime that we've been in. Now, we certainly could, right? If you think about the first half of the year, all the talk and the threats of tariffs, and then April 2nd, when it finally kicked off, and then him capitulating, we had spent a lot of time below the 10 during all of that. And it just seems so long ago, right? But it wasn't. It was just a few months back. But since then, after he capitulated and we've come back up, we've been running pretty steady. And there's no expectation that this is done yet. If it is, we haven't got the message. And maybe the bond vigilantes need to speak up a little bit, like they did after April 2nd. Can you hear me now? They need to run an AT&T commercial. That's what those bond vigilantes need to do. And then tie it in with those old ladies from Facebook where they're like, that's not how this works. That's not how any of this works. That would be a fantastic video. China's down, energy's down, China's down again, China again. Hey, you know what? China's down. Like literally, that's what all of these are. China and energy. Where's the beef? Yeah. No, it's got to be that Arby's one where he's like, we have the meat for sandwiches. The Mag 7 up volume is up. Yeah, I know it's a double positive, but really, roll with it. Um, and the mags are up. Precious metals and miners are up. Uranium communications. I'm always skeptical when I see communications is up. It's one of those weird ones that will lie to you if you just look at the changes overnight, right? So XLC, what happens, what I found out with this is a lot of times it will read the after hours, which happened, last night after the market closed at 4, and that's completely different than reading things pre-market. And yet it'll still say, hey, we're up on the day. Well, no, we're not actually up on the day. We were up after hours yesterday, and then today, this morning, we haven't done jack. We're just sitting where we were yesterday after we got popped up after hours. And that's XLC. And it happens with XLC quite a bit. So if you ever see this one up in the pre-market, actually go check the chart. Don't just look at the change percent, because that one will lie to you, just like today. This is not up in the pre-market. It's up from after hours last night. And that changes the dynamic. If we're reading this, looking at what's up and what's down this morning, XLC is not up this morning. XLC is up last night, and it still happens to be holding that this morning. It's two completely different things. But we do have the Mag 7 up. We got Quantum, Bitcoin. We got Risk this morning. Old School Tech is up. The S&P and NASDAQ. We've even got the sillier stuff like bots. So yeah, we got risk this morning. Nice. But is it going to be enough to get us to actually go anywhere? Holding the line is completely different than advancing forward. And you don't want a rally day with nat gas leading. The thing is trash. It looks like one of those triple leveraged ETFs, right? Just fades and fades and fades. The Mag 7, yeah, it's up in the pre-market. Had to check to make sure it wasn't after hours stuff, right? Still above all of its weekly moving averages of importance. Let's check that on the daily. Yeah, I mean, it's above the 10. It's a really tight range up there. Uranium, precious metal miners, Bitcoin, generic tech, pot stocks, emerging markets. I mean, that's basically China again. Chips are up. So we have the capacity for a rally day today because of the sectors and the industries that are up in the pre-market. So let's reevaluate this real quick and we wrap it up, call it a day. The opportunity always starts with getting out of the box, right? It's the first thing we got to do every single day. GTFO, get out of the box. And you can draw whatever box you like. I start with something simple like the Globex low and the Globex high, because that's the first box you have to navigate. If you can get out of this box, usually the next box is the RTH box, but we're already out of that one, right? If we was to carry this one forward, you can see we've already got an inside day breakout of the RTH range. So that one's fine. But then we've got all of yesterday to consider. And if you remember yesterday, I was telling you take Monday and put it in with everything that you got since Sunday night. So really, the box is actually a little bit bigger because we gotta use that data. It is a part of yesterday's trading. So the real box is like 64.92 cog line all the way down to 63.70. That's a big range in a single day. We got to GTFO that box, this big box, to get anything else done. Now, because it's such a big range, there's plenty of room to move around. It's 120 points, give or take, right? Some napkin math. There is plenty of room in that 120 point range to have some decent trend, really nice trade setups, signals, patterns, things that we can play. But if you're looking for a breakout, that's what you need to break out of. So GTFO the box, right? With what we have up in the pre-market today, we have the capacity to get out of this box. I'm not saying we're going to get out of the box. I'm saying that we have a chance to get out of the box because of the sectors that are up. If they begin to fail or stall or they just don't put in the work, we're not going to go anywhere. If headlines come in, it could all turn negative, or the headlines could be positive and boost us up through the levels. But at this point, you can't anticipate what you don't have. You got the known unknown, and then you got the unknown unknown. And if you haven't heard those phrases before, you really want to dig into them. Economic data like JOLTS, that's known unknown. We know it's coming. We don't know what the number is going to be. Unknown unknown are just headlines that hit, like, hey, a hurricane smashed into whatever, or a ship got stuck in the canal. Those were unknown unknowns. We didn't see them coming until they hit. The known unknowns today shouldn't be enough to break this range and get us going. JOLTS, right? It should not be enough. So watch the clock. Keep your eye on the ancillary products. and see what the satellites give us. That's what I got, guys. Be careful, be safe. See y'all tomorrow.